It's going to be much worse than 2008. I'm your host, Steve Van Metre, and thanks for joining me today. And Jaime Dimon, the CEO of JP Morgan Chase, is warning their high net worth clients that something much worse than the great financial crisis is coming. Let's however we pick up today's story as this headline with JP Morgan CEO Jaime Dimon told wealthy clients there's a chance the U.S. is heading into something worse than a recession. And Dimon reportedly said on a client call Tuesday that the economy is strong, but storm clouds were on the horizon, including federal monetary policies, Russia's invasion of Ukraine, and rising oil prices. The categorization is an apparent downgrade from Dimon's previous comments in June when he warned of an economic hurricane, but is it possible that this downgrade is simply because we're in the eye of the storm right now? Well, that's possible because if things continue on the current path, the third and fourth quarter aren't going to look that great. Consumers' balance sheets are in good shape, he said, and businesses are equally in good shape. When you forecast, you have to think differently. It is a bad mistake to say, here's my single point forecast. Well, it's challenged that consumer balance sheets are in good shape because the personal savings rate is at 5.1% and is continuing a huge downward spiral here, suggesting that the opposite is true, that consumer balance sheets aren't actually in good shape because they're saving less and less of their money, meaning they're being wildly impacted by rising prices and drawing down their savings. Let's continue on because the CEO said he had estimated the chances of a soft landing to be about 10%, perhaps being even generous, and the probability of a harder landing or a mild recession to be closer to 20 to 30%. And he reportedly had estimated a 20 to 30% chance of a harder recession and a 20 to 30% chance of something worse, which indeed is another financial crisis. Of course, as we all remember, the former Fed chair and now Treasury Secretary Janet Yellen said, was it going to happen again in her lifetime? And from a positioning standpoint, we're seeing that investors are completely unprepared for anything other than a mild recession because according to Bank of America, they're overweight equities and way overweight equities. Historically, they run around a 56% weighting of their portfolio. And recently, they're down from their high of 66%. But of course, we're still at 63, which is unusually high. And as we are in the midst of a bear market rally, people are even buying even more equities here, taking on more risk at a time where they should have some safety, and they don't. You see, investors have turned away from cash. They're turning away from bonds in the face of higher inflation, believing that interest rates can only go up. And so from a safety net perspective, they're only holding 18% in government debt and other debt, having no insurance against a downturn, or even worse, as Jaime Dimon suggests, something even worse that could come. And right now it's kind of sunny, he said, again, suggesting we may be in the eye of the storm. Things are doing fine. Everyone thinks the Fed can handle this, and which will challenge that statement. That hurricane is right out there down the road coming our way. We don't know if it's a minor one or Superstorm Sandy or Andrew or something like that. Well, Jaime, we do actually know it's going to be something worse because when we look at what the Fed's behavior is and what their actions do to the stock market, we can almost safely predict that we are indeed in the eye of the storm. And here you can see the Wilshire 5000 price index against the federal funds rate now shown in red. And you can see other than here in the early to mid 90s where the Fed raised rates and then paused, that the stock market was able to continue to head higher. But after that, the Fed went full bore again. And then stocks came down. We see it going into the great financial crisis. The Fed aggressively hiked, and what happened? They ended up pausing. And of course, as we all remember, the market just didn't come down. Nearly the global economy did. Of course, we see then again, starting in 2015, the Fed hikes again. The stock market continues to rally, which is what investors are betting on. But that led to a slowdown. If it wasn't for the pandemic, would have been another recession. And now the Fed, as you can see, on one of the sharpest increases in the federal funds rate in history. And at the same time, it's unwinding this balance sheet, which may be the X factor here that everyone's overlooking, as we have the Wilshire 5000 price index and the monetary base, or the Fed's balance sheet shown in red, red on a year-over-year rate of change, and we can see as the Fed reduces its balance sheet, well, that's bad news for stocks, and the Fed is set to increase its balance sheet unwind by more than double here coming starting next month. And if you're concerned at all what a balance sheet unwind or Jamie Dimon something worse could be to your portfolio, well, you shouldn't be. Put a link up here to Portfolio Shield and description below because it knows how to handle such crises. But let's go on because perhaps things are sunny as Dimon suggests, but maybe not for long. As U.S. retail spending held steady in July, suggesting that perhaps it could only get worse from here. Excluding autos and gasoline, spending did rise 0.7%. Overall retail sales, a measure of spending to stores, online, and restaurants, were flat in July compared with the prior month's revised 0.8% increase. With gasoline and auto sales removed, sales rose 0.7% from June. And shoppers have continued to spend despite the highest annual U.S. inflation in 4 decades, though they're getting less for their money because of higher prices. The retail sales figures aren't adjusted for inflation, which is true. They are not. So the question is, are we just seeing the retail sales number go up because consumer prices go up? Well, let's put that to the test. And here we have advanced retail sales in blue against the consumer price index in red, both on year-over-year rate of change. And lo and behold, there is a lot of symmetry to these two lines, suggesting that indeed one of the reasons that retail sales are as high as they are is because you and I are just paying more for stuff, and that is driving the change. Of course, what is really perhaps driving behind the retail sales push is gasoline prices, as you can see in red now when we overlay all regular formations of gas price in red. Also on a year-over-year rate of change, you can see as gasoline prices shoot higher, of course, consumers, they can cut back somewhat, but not that much. They still need fuel, and notably, we're seeing that gas prices on a year-over-year rate of change head lower, suggesting that what we're likely to see is retail sales come down, and that's not a good sign. It's coming down because of lack of demand, not the supply issue that everyone says. Let's take a look at the underlying report. We see motor vehicle and parts dealers, they're down 1.6%. Gasoline station down 1.8%. How about that? General merchandise stores down 0.7%. But notably, miscellaneous store retailers up 1.5%, and non-store retailers, which are catalog sales, shooting higher 2.7%. But talking about demand and supply, we have to look at the oil inventory reports. Look at this week, we see a drawdown of 7 million of crude oil inventory. We see Cushing, which is, of course, you think about what goes into gasoline. That's really where you want to see is Cushing is up almost 200,000 barrels. Distillate's up 766. But look at this, gasoline dropped 4.6 million barrels. Now you might say, well, wait, that means perhaps that there's a supply issue. I know it does appear that there is also a supply issue, but demand is going down even quicker. But check this out, gasoline demand is on average 5% below 2021 levels. There's your demand component, and despite lower oil prices, we expect it to remain subdued due to weak real wage growth. And that's just it. That is the point. You look at inflation adjusted wages, they're not keeping pace. We've talked about this on the show before, and people cannot afford higher prices, particularly, again, in energy prices. Now, of course, you can cut back on your gasoline usage. There are things you can do. We all know that. But there is a point where you can't. You still have to go to work. You still have to go to the store. You still have to take the kids to soccer practice and whatnot. There is only so far you can cut back. But here you can see on this chart, demand is actually coming down a little bit. And if that is a continued story, demand will come down even more. And here is a chart of average hourly earnings are not adjusted for inflation against U.S. regular all formations gas price in red, suggesting that wages, as we know, are not keeping up with inflation, are not keeping up with gas prices, and that's leading to less demand. And as demand goes down, and this is, again, a key point about the energy sector, if energy prices are coming down, it's not because they're coming down until all of a sudden new surge in supply. Now, that would be great because then we could say, look at all the supply coming onto the market, and that is meeting the demand, and even then some. What we're seeing is demand says we can't afford these higher prices. That's leading to a slower economy, ultimately to more layoffs and other problems. And as we turn to other problems, we note that our chief strategist, Jeff Snyder, points out the problems in China that we talked about yesterday are far more serious than we realize, as he says in his daily that he said he keeps an eye on the Japanese or Chinese currency, the yuan, as Treasury's tick estimates for the financial eventful month of June 2022 included another sharp drop in China's holdings of U.S. Treasuries. The Laos dollar is doomed. Observers for years have wrongly made this data into a political statement they claim supports a view of the world moving away from the dollar reserve standard. This view misses on all counts that the world has been more than half a century on a euro dollar, not dollar standard. He says whenever U.S. Treasuries leave China, we know the reason is monetary rather than political. I mentioned just recently, should China's currency hit new lows, that this would be an important omen about the global deflationary money conditions. He says not politics nor dollar doom, just the usual euro-dollar formula of yuan down, that's bad. Of course, if you want to hear more about what Jeff Snyder says, sign up for his daily report, my report, and of course our energy specialist, Tracy, who will be writing for tomorrow's report about the energy sector. Link in the description below is currently free, marketsinsiderpro.com. But as far as we can tell, the Jaime Dimon, he's gone all over the map by predicting multiple scenarios. But really, I think we're in the eye of the storm. Hang tight, because the third and fourth quarter are coming, and I don't think things will look that good. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.